Imagine putting a small amount of money into a stock and watching it grow 100 times over the years. That means if you put in $1,000, you would end up with $100,000. If you put in $10,000, you would end up with $1 million. This is not a fantasy or a lucky guess. This is something that has happened many times in the history of the stock market, and it can happen again. The book called 100 Baggers by Christopher Mayer is the guide that teaches you how to find these rare and powerful stocks before they make that incredible journey. Christopher Mayer spent years studying stocks that went up 100 times in value, and he wrote down everything he found so that ordinary investors like you and me can understand and apply the same thinking. This book is not about getting rich quickly. It is not about trading fast or jumping in and out of the market every few days. It is about finding the right company, understanding deeply why it is great, and then having the patience to hold on while it grows for years, and sometimes even decades. The ideas in this book are simple, but they are not easy to follow in real life. That is the honest truth. Knowing what to do and actually doing it are two very different things, and this book understands that gap perfectly. So let us go through the heart of this book, one idea at a time, in plain and simple language that anyone anywhere in the world can understand and use to build real and lasting wealth. Let us begin with the most basic question of all. What exactly is a 100 bagger? A 100 bagger is a stock that goes up in price by 100 times from where you bought it. If you buy a stock at $1 and it reaches $100, that is a 100 bagger. If you buy it at $5 and it reaches $500, that is also a 100 bagger. The word bagger comes from baseball, where a bag is a base. In investing language, people started using the term to describe how many times a stock multiplied in value. A 2-bagger doubles your money. A 10-bagger gives you 10 times your money. And a 100-bagger gives you 100 times your money. The idea of finding 100 baggers did not start with Christopher Mayer. It started much earlier with a man named Thomas Phelps, who wrote a book in the year 1972 called 100 to 1 in the stock market. Thomas Phelps spent many years studying stocks that returned $100 for every $1 invested. He wanted to understand what those companies looked like, how they grew, and what made them so special and different from ordinary companies. Christopher Mayer built on that original work, updated it with newer and more comprehensive research, and added his own deep analysis of what makes a company capable of becoming a 100-bagger in today's world. The research study that forms the backbone of this book looked at stocks from the year 1962 all the way to the year 2014. During that long time period, there were hundreds of stocks that reached the 100 times mark. That is actually quite a few when you think about it carefully, and the fact that so many stocks achieved this remarkable level of growth shows that finding a 100-bagger is not completely impossible. It is very rare, yes. It is very hard, yes. But it is not impossible. And the more you understand the patterns of what these stocks looked like before they became 100 baggers, the better your chances become of finding the next one before the rest of the world realizes how great it truly is. That is the fundamental promise of this book, and it is a promise worth taking very seriously because the stakes are enormous. Now let us talk about the most important finding from the research study. What do 100 baggers have in common? What qualities do they share? If you could look at all the stocks that went up 100 times and find the thing they all had in common, you would have a powerful tool for finding the next group before they complete their journey. And Christopher Mayer did exactly that. He found that the biggest common factor is this: the company must grow its earnings over a long period of time. That sounds simple, and in some ways, it truly is simple. But the depth behind that simple statement is enormous, and understanding it fully takes real effort and careful thought. To grow earnings 100 times, a company needs to grow at a good rate for many, many years. It cannot just have 1 or 2 good years and then stop. It needs to keep growing, year after year, decade after decade, through good economic times and bad ones. This kind of sustained and consistent growth requires very specific qualities in a business. It requires a strong competitive advantage that protects the business from the constantly attacking forces of competition. It requires a large and growing market where the business can keep selling more and more without hitting a ceiling. It requires skilled and passionate leadership that keeps making smart and forward-looking decisions even when the short term looks difficult. And it requires the ability to take the profits the business earns and put them back into the business to earn even more profits in the future, creating a cycle of growth that builds on itself year after year. That last point is so important that Christopher Mayer calls it one of the twin engines of a 100-bagger. Let us talk about these twin engines now, because they are central to everything in the book and to everything that makes a great long-term investment. The first engine is a high return on capital. Return on capital means how much profit a company earns compared to the money it has put into the business. If a company invests $100 into its operations and earns $20 of profit, that is a 20 in 100 return on capital. That is a very good return. If a company invests $100 and only earns $5, that is a 5 in 100 return on capital. That is a weak return, and it suggests the business is not particularly efficient. Companies with high returns on capital are efficient machines. They are very good at turning the money they invest into profit. And the higher this number is, the faster the company can grow its value over time without needing to raise enormous amounts of additional money to fund that growth. The second engine is reinvestment. This means the company takes the profits it earns and puts them back into the business to earn even more profits on top of the original ones. This is how compounding works in the real world of business. Compounding is one of the most powerful forces in the entire world of money and finance, and yet most people do not truly appreciate how powerful it is until they see real numbers over real time periods. When you earn a return on your investment and then reinvest that return to earn another return on top of it, and then reinvest that again to earn yet another return, the growth becomes faster and faster over time. It starts slowly in the early years, but then it begins to accelerate in a way that surprises and delights those who have the patience to wait for it. Think of it like a snowball rolling down a long hill. At the very start, the snowball is small, and it picks up only a little bit of snow with each rotation. But as it grows bigger, it picks up more and more snow with each rotation of its now larger surface. After a long enough time, rolling down a long enough hill, what started as a tiny ball of snow has become a massive, unstoppable force rolling down the mountain. A company that earns a high return on capital and reinvests those earnings back into the business at that same high return is doing exactly what the snowball does. It is getting bigger and bigger, faster and faster with each passing year. And the investor who owns that company benefits from every single turn of that growing snowball. This is why the combination of high return on capital and the ability to reinvest at those high returns is called the twin engines. Together, they are the motor that drives a stock to become a 100-bagger over time. Without both engines working together, you simply cannot get there. A company might have a very high return on capital, but have no room to grow and reinvest those earnings because its market is already saturated. That company will be profitable, but will not grow much, and its stock will not multiply many times. A company might have a huge market to grow into, but earn a very low return on capital, meaning it is not very efficient. That company will grow in size, but will not create much value for investors because too much capital is required to generate each dollar of earnings. You need both engines, high return on capital and the opportunity to reinvest that capital at those high returns for many years. That is the recipe, and it is not as common as you might hope. Most businesses have one or the other, but not both, and not for long periods. Finding a company that has both, and that can sustain both for decades, is finding something truly rare and special. Now, let us talk about the size of the company when you find it. One of the biggest insights in the book is that small companies have a much better chance of becoming 100 baggers than large companies. This makes perfect sense when you think about it in a clear and logical way. A company worth $1 billion that needs to become worth $100 billion to give you a 100 times return is facing a massive and very difficult challenge. There are very few companies in the entire world worth $100 billion. Getting from 1 billion to 100 billion requires the company to grow to a size that almost no companies in history have ever reached. But a company worth $10 million that needs to reach $1 billion is facing a much more realistic journey. Many companies are worth $1 billion. Reaching that level from 10 million is still very hard, but it is much more achievable than reaching 100 billion from 1 billion. And a company worth $1 million that needs to reach $100 million is facing the most achievable version of the journey. This is why small companies, especially very small companies, are the most fertile hunting ground for 100 baggers. The starting point matters enormously, and a low starting point is one of the most powerful advantages a potential 100 bagger can have. A small, growing company in a large market has all the room it needs to expand and multiply in value over many years. A large company that already dominates its market has very little room left to grow in a meaningful way. This does not mean you should blindly buy any small company you come across. Most small companies never grow into big companies. Many of them fail entirely, and their investors lose everything. But among the small companies with all the right qualities, which we will discuss in detail very shortly, the ones that succeed can give you returns that simply are not possible with large companies. So the first filter when looking for potential 100 baggers is to look at smaller companies rather than the household names that everyone knows. The big names everyone talks about on the news and in casual conversation are almost never going to be the next 100 bagger because they are already too big and too well known. The companies you have probably never heard of, operating in markets you might not know well, making products or providing services that are quietly growing in demand every day, those are the ones to focus your attention on. Now let us talk about the role of the leader. Who runs the company matters enormously when you are thinking about a very long holding period. One of the strongest signals that a company might become a 100 bagger is the presence of an owner-operator at the helm. An owner-operator is a person who both runs the company day to day and owns a significant amount of its stock. This is very different from a hired manager. A hired manager gets paid a salary and sometimes a bonus, whether the company does well or poorly. A hired manager might make decisions that look good in the short term to earn a performance bonus, even if those decisions hurt the company in the long term. A hired manager might not feel the pain of a bad decision the same way a true owner does, because the hired manager's personal wealth is not primarily tied to the outcome. But an owner-operator has skin in the game, as the saying goes. When the company loses money, the owner-operator loses personal wealth directly. When the company grows, the owner-operator grows richer personally. This powerful alignment between the leader and the shareholders, meaning the people who own stock in the company, is one of the most important factors in long-term business success. When the person running the company thinks and behaves like an owner, every single decision is made with the long-term health of the business in mind. These leaders tend to avoid wasteful spending that makes the office look impressive but does not help the business grow. They tend to think very carefully before taking on significant debt that could endanger the company during a downturn. They tend to make decisions that might hurt the stock price in the short term but will make the business stronger and more competitive in the long run. They are not trying to impress stock market analysts or boost the quarterly earnings number for a short-term stock price gain. They are building something they own and care about deeply, something they want to be proud of and to leave as a legacy. Many of the greatest 100 baggers in history were led by owner-operators who stayed with the company for decades. Warren Buffett is a very famous example of this kind of ownership thinking applied to investing in companies. He has always talked about the critical importance of investing in companies where the leaders think and act like long-term owners, and he has practiced this belief consistently throughout his career. Christopher Mayer agrees completely, and the research from the study of historical 100 baggers strongly supports this view. When you find a small company with a high return on capital, a large market to grow into, and a founder or major owner running the business with passion and skill, you have found something very special indeed. Now let us talk about the competitive advantage, or what many investors call the moat. A moat is the thing that protects a company from competition, and it is absolutely essential for a 100 bagger. In the old days, castles were surrounded by a deep moat of water to keep enemies from attacking the walls and overrunning the defenders. In business, a competitive advantage is the equivalent of that protective moat. It is what keeps competitors from taking away a company's customers and destroying its profits. Without a moat, a profitable business will quickly attract competition. Competitors will see that the business is making good money and try to do the same thing by copying the products, the pricing, or the model. If the original business has no protection, those competitors can take away its customers by offering lower prices or slightly better products. And eventually, the profits of the original business will shrink dramatically because of the pressures of competition. But a business with a strong moat can defend itself effectively year after year. It can keep its customers, maintain its pricing power, and protect its profits even when competitors try very hard to take them away. There are many different kinds of moats, and understanding each one is important for finding great long-term investments. One kind is the power of a strong brand. A company with a powerful and well-loved brand has something intangible but very real that competitors simply cannot easily copy. People trust the brand, they feel loyal to it, and they will pay a higher price for it over an unknown or untrusted alternative. Building a great brand takes many years of consistent quality and marketing investment, which means it is very hard for a newcomer to quickly replicate. Another kind of moat is the network effect. A network effect happens when a product or service becomes more valuable to each user as more people use it. Social media platforms are a very good and well-known example of this. A social media platform with 1 million users is much more valuable to each of those users than one with only 1,000 users, because there are vastly more people to connect with, share with, and communicate with. This makes the platform very hard to replace, because any new competitor starting from zero would have a much less valuable product in the early days, even if it had superior features in some technical sense. The value comes from the existing network, not from the technology alone. Another kind of moat is switching costs. When a customer has spent years using a particular software system or service and has built all their internal processes and workflows around it, switching to a competitor requires enormous effort, retraining, disruption, and risk. This makes the customer very unlikely to switch, even if a competitor offers a somewhat better product or a lower price. The pain and cost of switching outweighs the perceived benefit of the alternative, which means the original company can keep that customer for a very long time. Another kind of moat is cost advantage. Some companies can produce their product or service at a significantly lower cost than any competitor, not because they are cutting corners on quality, but because of their massive scale, access to unique resources, or consistently superior operational processes. This allows them to price lower than competitors and still make a healthy profit, or to charge the same price and make a higher profit, either of which gives them a powerful, long-term advantage. Another kind of moat is regulatory advantage. Some companies have licenses, patents, or regulatory approvals that are very hard and very time-consuming for competitors to obtain. Pharmaceutical companies with patented drugs enjoy this kind of strong protection for the entire duration of the patent. Utilities that hold exclusive licenses to serve a particular geographic region have this kind of protection too. These legal barriers to entry can be enormously valuable for the companies that hold them. The strongest 100 baggers tend to have at least one powerful moat, and often more than one type of protection working together at the same time. The moat is what allows the company to grow for many decades without being destroyed or fatally weakened by competition. Without the moat, even a fast-growing company will eventually see its growth slow dramatically as competitors catch up and copy what it does successfully. With a strong moat, the company can keep growing and keep earning high returns on capital for much longer, which is exactly what is needed to become a genuine 100 bagger. Now let us talk about the market in which the company operates. The size and growth rate of the market matters enormously for a potential 100 bagger. A company selling a product that only a small number of people want has a natural ceiling on how big it can ever grow. No matter how perfectly it executes its strategy, it cannot grow beyond the limits of the total market it serves. But a company selling something that a vast and growing number of people want or need has almost no ceiling on its potential growth. The best 100 baggers tend to operate in large and expanding markets. They are not selling to a niche of 10,000 people who have a very specialized need. They are selling to millions, or even hundreds of millions, or even billions of people worldwide. And often, the market itself is growing rapidly, meaning more and more people are becoming potential customers every single year, regardless of what the company itself does to attract them. Think about what happened with the internet during its early years of expansion. Companies that sold internet services or products in those early days were operating in a market that was growing explosively, with millions of new users coming online for the first time every year. A company that captured even a small and seemingly modest slice of that expanding market could grow extremely fast simply by riding the wave of overall market growth. Or think about emerging markets around the world, places where hundreds of millions of people are entering the middle class for the first time and starting to spend money on products and services they could not afford before. A company that sells everyday goods to those newly prosperous consumers is operating in a market that is growing rapidly and will continue to grow for many years as more people join the middle class. The combination of a large market today and a market that is also growing rapidly for the future is the ideal environment for a potential 100 bagger. The company does not even need to take market share away from existing competitors to grow fast in this situation. It can simply ride the wave of the growing total market and still multiply in value many times over. Of course, growing market share on top of a growing total market is even better and can produce even faster stock price gains. But even without winning market share battles, a rising tide of market growth can lift a company's revenues and earnings a very long way over a long period of time. Now let us talk about something that many investors overlook, which is the critical importance of the price you pay when you first buy the stock. You might find a wonderful company with all the right qualities: high return on capital, owner-operator leadership, a strong moat, a large and growing market. But if you pay too high a price for that company, you will still not make a truly great return on your investment. The price you pay matters. It matters a very great deal, and it should never be ignored or treated as a minor detail. If a great company is priced perfectly, in the sense that the market already fully understands how good it is, and the price already reflects all of that expected future growth, then you will earn just an average return, even if everything goes exactly as planned. To earn truly extraordinary returns, you need to find a great company at a reasonable or even cheap price. This is genuinely harder than it sounds. the market is not stupid. Most of the time, when a company has all the qualities that make it look like a potential 100 bagger, the market already knows about many of those qualities and the price is already elevated to reflect them. But sometimes, the market misunderstands a company for various reasons. Sometimes, the market is too focused on short-term problems and misses the long-term potential that is quietly building. Sometimes, a company is so small that the large institutional investors with billions of dollars cannot buy meaningful amounts of it, so they ignore it completely, leaving it to trade at a price below what it is truly worth in the long run. These are the moments when you, as an individual investor, can buy a great company at a fair or even cheap price. And when you combine a great company with a fair price, the potential for exceptional long-term returns becomes very real and very exciting. Christopher Mayer talks about a simple way to think about the price and whether it is reasonable. He suggests looking at a valuation measure called price to earnings. This is the price of the stock divided by the earnings the company makes per share. It tells you how many years of current earnings you are effectively paying for the company when you buy it. A price to earnings of 15 means you are paying the equivalent of 15 years of current earnings. A price to earnings of 30 means you are paying 30 years of current earnings. He also talks about other ways to think about the value of a company, like asking what a sensible private buyer would be willing to pay to acquire the entire business and own all of its future cash flows. But the most important point is not the specific number itself. The most important point is that you should not pay a crazy and extreme price for even the best company in the world. You should try to buy great businesses at reasonable prices and then hold them for a very long time while the business grows. The holding part is perhaps the most crucial element of all, and we will get into it very deeply very soon. But first, let us talk about growth and the numbers behind it. How much does a company need to grow each year to eventually become a 100 bagger? Let us think about this with simple and easy to understand numbers. If a company grows at 15 in every 100 per year, it will roughly double about every 5 years. That means in 20 years, it will be about 16 times bigger than it was at the start. At 30 years of consistent growth, it will be about 66 times bigger. At 35 years of that same steady growth, it will be more than 100 times bigger. So with consistent growth of 15 in every 100 per year, maintained for roughly 30 to 35 years, a company can become a 100 bagger. If the company grows faster, say 20 in every 100 per year, it can reach 100 times in about 25 years. At 25 in every 100 per year growth, it gets there in under 20 years. These calculations assume that the price to earnings stays constant over time, meaning the market always values the company at the same multiple of its earnings throughout the entire journey. If the multiple expands, meaning the market becomes more excited and enthusiastic about the company and pays a higher price relative to earnings, the journey to a 100 bagger can be much faster than these numbers suggest. And if the multiple shrinks, meaning the market becomes less excited and pays a lower price relative to earnings, the journey takes longer. This is precisely why buying at a reasonable, rather than extreme price helps you so enormously as an investor. If you buy a company when its price to earnings is low, and the market later recognizes its quality and begins to pay a higher multiple for the same earnings, you benefit from both the growth in earnings and the expansion in the multiple at the same time. These two things, working together, can make the stock grow much faster than either one alone would suggest. Some of the greatest and most dramatic stock gains in the entire history of investing came from this powerful combination of rapidly growing earnings and a simultaneously expanding price to earnings multiple. The stock grew on two fronts at exactly the same time, and the combined result was nothing short of stunning. But now, we must talk about perhaps the most important and certainly the most difficult part of investing in 100 baggers. We must talk about holding on and continuing to hold on even when every instinct and emotion is telling you to sell. This is where the vast majority of investors fail, even those who have done the hard work of finding a genuinely great company. Even investors who correctly identify a great company at a reasonable price often sell too early and miss the vast majority of the potential gain. They sell when the stock doubles, feeling satisfied and clever. They sell when the stock triples, feeling very smart and prudent. They sell when there is a scary piece of news about the economy or the company or the industry. They sell when the broader stock market falls sharply and takes all stocks down with it. And by selling in all of these situations, they miss the vast majority of the gain that a genuine 100 bagger produces. Think about this very carefully. If a stock is going to go up 100 times over 25 years, it will go up an enormous amount along the way to that final destination. It will double. Then it will double again. Then it will double again. And again and again and again. Every single time it doubles, the majority of investors feel very tempted to take their profit and move on to something else. But if you sell after the first double, you miss the next 49 times return that is still to come over many more years. If you sell after the second double, you miss the next 24 times return that is still ahead. The longer you hold, the more of that extraordinary journey you capture. The returns do not come in a steady and predictable stream. They come in sudden bursts, followed by long flat periods, and sometimes frightening drops. But over the full course of the journey, the patient investor who stays on board collects the full extraordinary reward. Christopher Mayer introduces in this context what he calls the coffee can portfolio, borrowing the concept from an earlier investor named Robert Kirby, who first wrote about it. The concept is beautifully simple. You put your best stocks in a metaphorical coffee can, seal the lid tightly, and put it in a drawer for 10 years or more. You do not look at it every day. You do not react to every piece of news, good or bad. You do not sell when the broader market falls. You do not sell when the stock doubles. You do not sell when something scary happens in the world. You just hold. You hold through the scary times when it seems like the world is ending. You hold through the boring times when nothing seems to be happening with your investment. You hold through the times when your friends are excitedly buying new things and your old steady stock seems dull and unexciting by comparison. You just keep holding. This is not easy at all. It goes against almost every instinct that most people have about managing money and investments. When a stock falls 20 in every 100, the natural human feeling is fear and the very strong desire to stop the pain by selling and getting out. When a stock rises very fast, the natural human feeling is a mix of greed and anxiety and the desire to lock in the profit before it somehow disappears. Both of these very human feelings lead to selling at exactly the wrong time. The coffee can approach says that you should ignore both of these feelings and just keep the can sealed and the investment untouched. Research has actually shown very clearly that this approach works. Studies have consistently shown that the average investor earns much less than the average stock market return, primarily because investors trade too much. They buy when they feel confident and optimistic, and sell when they feel scared and uncertain, which means they are effectively buying high and selling low, the exact opposite of what good investing requires. The investor who simply buys a great company and holds it for many years, doing very little else, often earns far more than the active trader who is constantly buying and selling in search of the next opportunity. This is deeply counterintuitive. Most people assume that doing more must be better, that activity equals progress and results. But in investing, doing less in the sense of holding on to great companies rather than constantly trading in and out of positions is very often the winning strategy. There is a famous and instructive story of a woman who opened a brokerage account in the 1950s and then completely forgot about it. When her account was discovered many decades later, it had grown to millions of dollars because she had unknowingly and accidentally applied the perfect coffee can approach. She held on through market crashes, recessions, booms, and busts over many decades, and in the end, she found herself very wealthy. This story captures the extraordinary power of patient holding better than almost any argument could. The challenge, of course, is knowing when you should sell. Because sometimes you should sell. There are genuinely good reasons to sell a stock, and pretending otherwise would be dishonest. Sometimes, the reasons you originally bought a stock in the first place no longer exist. Sometimes, the competitive advantage that made the company special has disappeared or been eroded significantly. Sometimes, the owner-operator leaves and is replaced by a hired manager who begins making short-sighted decisions. Sometimes, the industry changes in a fundamental technological way that the company cannot adapt to successfully. In those cases, holding on stubbornly is not wisdom or patience. It is stubbornness that will cost you dearly. Christopher Mayer does not say you should never sell. He says you should only sell when the fundamentals of the business have changed in an important and material way, not because the stock price has gone up or down, or because you are feeling scared or greedy or impatient. The most important question to ask before deciding to sell is, has something genuinely important changed about the underlying business itself? If the honest answer is no, and the business is still growing well and still has its competitive advantages intact, then the right decision is almost certainly to hold on. If the honest answer is yes, something truly important has changed about the business and the future looks materially less bright than it once did, then selling makes complete sense. Making this distinction clearly and without letting emotions cloud your judgment is one of the hardest skills in all of investing, but it is also one of the most valuable skills a long-term investor can develop. Now let us talk about avoiding big losses, because this is just as important as finding big winners. Christopher Mayer is very clear and direct on the fact that one of the most important things any investor can do is to avoid losing a large amount of money. A big loss is not just painful emotionally, it is mathematically devastating in ways that people often fail to fully appreciate. If you lose 50 in every 100 of your money, you need to make a gain of 100 in every 100 just to get back to exactly where you started. If you lose 90 in every 100 of your money, you need to make a gain of 900 in every 100 just to return to your original position. These are very deep and very hard holes to climb out of. Many investors never fully recover from a major loss, and the time spent recovering from a big loss is time that could have been spent compounding gains in a better investment. Christopher Mayer quotes the brilliant investor Charlie Munger, who says that the first rule of compounding is to never interrupt it unnecessarily. Every time you take a big loss, you break the compounding chain that has been building in your favor. You have to start again from a lower point, and all the future growth that would have compounded on top of that lost money is simply gone forever. That is the true hidden cost of a big loss. Not just the money that is gone, but all the compounding that money would have done for you over the future years. This is why 100-bagger investing is not about taking wild swings on speculative long-shot investments. It is about finding very high-quality companies that are unlikely to fail permanently, buying them at reasonable prices, and holding them for a very long time. The natural goal is to avoid the catastrophic losses that set you back years, while letting the genuine winners run for as long as possible. This approach naturally protects against big losses because you are fundamentally focused on buying quality. A high-quality company with a strong moat, a skilled owner-operator, and a large growing market is much less likely to collapse completely than a speculative company with no meaningful earnings, no competitive advantage, and a large and growing pile of debt. Speculative companies can indeed go up very fast when sentiment is in their favor, but they can also go to zero very fast when sentiment turns or when reality catches up with the story. And when they go to zero, your entire investment is gone completely and permanently. The 100-bagger approach focuses on quality, which provides a natural and powerful protection against catastrophic permanent loss while still offering the possibility of spectacular long-term gain. Quality and the avoidance of big losses are not at odds with the pursuit of great returns. They are actually the same thing, approached from two different directions. Now, let us go deeper into what Christopher Mayer describes as the key characteristics to look for in a potential 100-bagger. He has developed what amounts to a checklist of qualities that he examines carefully in any company he considers for long-term investment. Let us go through each one in good detail. The first is earnings power and earnings growth. A 100-bagger must have growing earnings over time. The earnings are the profits the company makes after paying all of its costs and expenses. If the earnings are not growing consistently, the stock price simply will not grow in a sustained way over the long term. You want to see a clear track record of growing earnings over several years, and you want to have a strong and well-reasoned case for why those earnings will continue to grow in the future. The second characteristic is the return on equity and return on invested capital. These are the important measures of how efficiently the company uses the money invested in it to generate profits for shareholders. High numbers here are very positive and are often a sign of a powerful competitive advantage. They tell you that the company is an efficient machine, earning a lot for every dollar of capital it employs in the business. Companies with very high return on invested capital are often the ones with the strongest and most durable competitive advantages, because that high return is only possible if there is something protecting the business from competition eating away at its profits. The third characteristic is financial strength. A company with a large amount of debt is fundamentally vulnerable. If times get hard and the business temporarily earns less money due to a recession or competitive pressure, a heavily indebted company might struggle to pay its bills and could even go bankrupt, wiping out shareholders completely. A company with little or no debt and a healthy amount of cash is much safer and much more resilient. It can survive difficult times and even take advantage of them by acquiring competitors or valuable assets cheaply when everyone else is struggling to survive. Christopher Mayer is not dogmatic about debt. He recognizes that some debt can be sensible and even beneficial if the business is very stable and generates highly reliable cash flows. But he is appropriately wary of companies with large amounts of debt, especially in businesses whose revenues are not predictable or stable. The fourth characteristic is the track record. How long has the company been around, and how consistent has its growth been over the years? A company that has grown its sales and earnings consistently for 5 or 10 or more years has demonstrated something very important and reassuring. It has shown that it can grow through different economic conditions, through different competitive challenges, and through different management situations. A company that had one spectacularly good year and then stumbled is much less impressive and much less reliable as a candidate. The longer and more consistent the track record of solid growth, the more confidence you can reasonably have about the continuation of that growth in the future. The fifth characteristic is the market opportunity. As mentioned earlier, the size and growth rate of the market the company operates in matters a very great deal. A company in a shrinking or stagnant market will struggle to grow no matter how well it executes its strategy. A company in a rapidly growing market has powerful wind at its back, helping it grow even when execution is imperfect. The ideal candidate is a company that is winning market share within a market that is itself getting bigger every year. The sixth characteristic is the quality of management. Is the company led by passionate, intelligent, and deeply honest people who genuinely care about the long-term health of the business? Are they skilled capital allocators, meaning do they make consistently good and value-creating decisions about where to invest the company's money and resources? Do they treat all shareholders fairly and with respect, or do they enrich themselves at the expense of the people who own the company? These questions require careful study and cannot be answered quickly or superficially. Reading the company's annual reports and shareholder letters carefully over multiple years can reveal a great deal about the true quality and character of management. The best managers explain complex things clearly and in plain language, take personal responsibility for mistakes rather than blaming external factors, and have a consistent and logical long-term strategy that they articulate well and follow faithfully. The worst managers use vague and confusing language full of jargon, always have convenient excuses for bad results, and constantly change strategy without a clear explanation for why the old strategy was abandoned. The seventh characteristic is the valuation. As we have discussed, the price you pay matters very much. You want to pay a fair or reasonable price for a great business, not an extreme and speculative price that already prices in many years of perfect execution. Overpaying for a great business can reduce your returns significantly and can even result in a loss if the market later decides the business deserves a lower valuation for any reason. Now let us talk about one more very powerful idea from the book. Christopher Mayer talks at length about the importance of finding companies that sell something that people need to buy again and again, month after month, and year after year. This is what sophisticated investors call recurring revenue or a recurring purchasing pattern, and it is enormously valuable. If a company sells something that customers buy once and then never need again, the company has to constantly find new customers to replace the ones who have already bought the product. That is expensive, exhausting, and very difficult to sustain over long periods. But if a company sells something that customers buy repeatedly on a regular basis, maybe every month, every year, or every time they run out of what they have, then the company has a much easier and more predictable path to growth. It can keep earning revenue from the same customers it already has, and each new customer it wins adds to the total base without replacing an old customer who is gone. Software sold on a subscription basis is perhaps the best modern example of this principle at work. A company that sells software on a monthly or yearly subscription earns money from each customer every single month or every year, as long as that customer remains satisfied with the software and continues to renew. As long as the customers are genuinely happy with what they are getting, they keep paying, and that creates a very predictable and growing stream of revenue. This is called recurring revenue, and the stock market tends to value it very highly because of its predictability and its tendency to grow steadily over time. Consumer staples companies, which sell things like food, cleaning products, and personal care items, also benefit from this pattern in a slightly different way. People buy food every week without fail. They buy soap and shampoo regularly. They buy their favorite beverages almost as a matter of habit and routine. These companies do not need to convince their customers to try the product for the very first time every single time a purchase is made. They just need to make sure their products are consistently good enough that customers keep choosing them over the alternatives. The more of a company's revenue that comes from this kind of reliable, predictable, repeat purchasing behavior, the more predictable its future earnings are. And the more predictable its future earnings are, the more confidently you can project its growth into the future and assess whether it has the potential to become a 100-bagger. Now let us talk about something that Christopher Mayer explores in an honest and thoughtful way, which is the complex role of luck versus skill in finding 100-baggers. He is admirably honest about this. Finding a 100-bagger requires real skill, but it also requires some good fortune. You need to be looking in the right places at the right time. You need to see an opportunity that most others have missed or are not paying attention to. You need to buy at the right time and at a reasonable price. And then you need to be fortunate enough that nothing goes terribly or permanently wrong over the many years it takes for the stock to reach its full potential. A lot can happen in 20 or 30 years. Industries change in ways that nobody predicted. Technology disrupts old and established ways of doing business. Governments pass new regulations that benefit some companies and hurt others. Economies go through recessions and unexpected booms. Even the very best company in the very best industry can face unexpected challenges that slow its growth significantly or even reverse it for a period of time. Christopher Mayer is not being discouraging when he discusses luck. He is simply being honest and realistic, which is one of the qualities that makes this book so trustworthy and valuable. He says that you should set up your investment approach in a way that accounts honestly for the fact that not every potential 100 bagger will actually become one, no matter how good the analysis. You might buy 10 stocks that you genuinely believe have all the right qualities to become 100 baggers. Maybe 2 or 3 of them will truly become 100 baggers if you hold them long enough. Maybe 5 of them will become 5 baggers or 10 baggers, which are still very good investments. And maybe 2 or 3 of them will fail or deliver disappointing returns, despite looking so promising at the beginning. But if you hold on to the whole group without selling the winners too early, and you have even 2 or 3 genuine 100 baggers in that group, the returns from those extraordinary winners will more than compensate for all the disappointments. This is another very important reason why holding on is so critical. If you sell your winners too early, whenever they double or triple, you eliminate from your portfolio the very stocks that might turn out to be 100 baggers hidden within the group. You should hold on with conviction and let the best companies reveal themselves fully over time. The cream will rise to the top, and when it does, you want to still be holding a substantial position in it. Let us now look at some of the real-world examples that Christopher Mayer uses in the book. He examines many famous and not-so-famous companies that became 100 baggers over the decades of the study period. One example he discusses in depth is Amazon. Amazon started as a simple online bookstore run from a garage, but it had a vision that extended far beyond just selling books online. The founder, Jeff Bezos, was an owner-operator in the truest and most complete sense. He owned a very large amount of the company and ran it with an exceptionally long-term vision that most analysts and investors did not understand or appreciate in the early years. He was willing to sacrifice short-term reported profits to invest aggressively in the future infrastructure and capabilities of the company. He kept expanding into new product categories, new technologies, new geographies, and entirely new services like cloud computing. The market the company operated in was vast, essentially all of commerce and all of the internet, and that market was growing explosively every year. Amazon had powerful and growing network effects as more buyers and sellers joined its platform, and it had significant cost advantages as it scaled to enormous size. The result was a stock that went up many hundreds of times from its early trading price, rewarding those few investors who had the vision to see what it was building and the patience to hold on through many scary drops and periods of doubt. Another example Christopher Mayer discusses is Monster Beverage, the energy drink company. Monster started as a relatively small company, selling an energy drink that competed head-to-head with the already dominant Red Bull brand. But it found a way to position itself differently in terms of branding and marketing, attracted a passionate customer base among young people who identified with its edgy image, and built a powerful distribution network. Over time, it grew its distribution to more and more stores and markets, expanded into new geographies, and built a strong and recognizable brand. The stock went from a very small price to a price many hundreds of times higher over a period of roughly 15 years. It was one of the very greatest performing stocks of its era. What made Monster special? It operated in a growing market for energy drinks that was expanding rapidly as the category became mainstream. It had a strong and differentiated brand that resonated with its target customers. It kept reinvesting its profits to grow distribution and expand into new markets. The formula was exactly the same as what we have been discussing throughout this summary. Another category of examples Christopher Mayer explores is companies in other parts of the world that followed a similar path to Amazon in their own regions. Companies like Mercado Libre in Latin America, which built the dominant e-commerce marketplace for that region, or Sea Limited in Southeast Asia, which built a dominant gaming and e-commerce platform for that part of the world, followed a path remarkably similar to Amazon in their respective regional markets. They started small, operated in large and fast-growing markets, were led by passionate founder-operators who thought in decades rather than quarters, and invested heavily and consistently to expand their reach and strengthen their positions. The results were explosive growth in their stock prices over many years. These examples illustrate the patterns that Christopher Mayer describes throughout the book with such consistency and clarity. The names and the locations and the specific industries change, but the underlying qualities that produce 100 baggers are remarkably consistent. High return on capital, reinvestment opportunity, strong competitive advantage, growing market, and skilled owner-operator leadership. Now let us talk about something very practical. How do you actually find these companies? Where do you look for them in the real world? Christopher Mayer suggests several specific approaches that any investor can follow. The first is to read very widely. Read business publications, trade magazines, annual reports of companies and industries you find interesting, and anything else that gives you genuine and useful information about companies and industries. The more you read over time, the more you will learn, and the more likely you are to come across something genuinely interesting before it becomes widely known and already reflected in the stock price. The second approach is to think carefully about what is changing in the world. New technologies create entirely new markets that did not previously exist. Changes in demographics create new needs and new demand for different kinds of products and services. Changes in government regulations create new opportunities for some companies while creating threats for others. When something important changes in the world, ask yourself honestly which companies will benefit from that change and which will be hurt by it. The answer to that question often points toward interesting investment opportunities worth researching further. The third approach is to look very deliberately and systematically at small companies. As we have established clearly, small companies are where the best potential 100 baggers are most often hiding. Make an effort to follow smaller company news, to read about small business ecosystems in various industries, and to explore companies that are not covered extensively by major financial media. Do not limit yourself to the household names that everyone already knows. The fourth approach is to look at what some of the most skilled and successful long-term investors are buying. There are investors who have demonstrated a genuine and consistent track record of finding great small companies and holding them for very long periods. Looking at what those investors are buying can point you toward interesting ideas worth your own independent investigation. Of course, you should never buy something simply because someone you respect bought it. You need to independently understand the business yourself and form your own well-reasoned view about it. But skilled investors can efficiently point you toward opportunities worth exploring in depth. The fifth approach is to pay attention to what insiders are doing. When the very people who run a company are buying its stock with their own personal money, that is a very meaningful and positive signal. They know the business from the inside better than anyone else in the world. If they are choosing to put their own hard-earned money into the stock, they clearly believe the stock is undervalued relative to the future potential they see. Insider buying is not a guarantee of future success and should not be the only thing you look at. But it is a genuinely useful signal worth paying attention to. Now let us talk about the challenge of staying focused and disciplined when others around you are excited about something entirely different. One of the greatest and most frequent tests for a 100-bagger investor is the constant temptation to abandon your patient, quality-focused approach in favor of chasing the exciting thing that everyone else is talking about. When the market is booming and speculative stocks are going up rapidly, your steady quality companies might seem boring and old-fashioned by comparison. Your friends might be making quick profits on speculative trades, while your holdings seem to do very little in the short term. This is a very real and very difficult test of character and conviction. The investor who stays focused on quality and patient holding will, over a long enough period of time, almost certainly outperform the investor who chases the exciting thing of the moment. But that outperformance requires time to emerge, and in the short term, the chaser can appear to be winning. And short-term results are what most people see and talk about in daily conversation. Christopher Mayer is honest about this difficulty and does not pretend that the right approach is always comfortable or easy to follow. He says that the strategy of seeking 100 baggers requires a genuinely long time horizon and the real ability to ignore short-term noise. It requires trusting your process even when others are laughing at your patience or questioning your judgment. It requires the confidence that comes naturally from having done the hard work of truly understanding the businesses you own. This kind of confidence is not arrogance or stubbornness. It is the natural result of careful study and deep understanding of what you own and why you own it. When you truly understand in depth why a company is great and why its competitive advantage is durable, you do not panic when the stock price falls 20 in every 100 for reasons unrelated to the business. You see that price decline as an opportunity to buy more of a great business at a lower and more attractive price. And when others are chasing a speculative stock that has nothing truly supporting its price but excitement and momentum, you do not feel the dangerous urge to join them. You feel instead the calm confidence of someone who knows exactly what they own, why they own it, and what its long-term potential truly is. This is the mindset that the best long-term investors in history have cultivated and maintained through many cycles of boom and bust, and it is something that Christopher Mayer works hard to help readers build through this book. Let us now return to and go deeper into the mathematics of compounding, because it is the true foundation of everything we are discussing. The power of compounding over very long periods of time is something that most people know about in an abstract sense, but do not truly feel in a visceral way that guides their behavior. Let us make it more concrete and more personal. If you invest $10,000 in a company that grows at 20 in every 100 per year, after 5 years, you will have about $25,000. After 10 years, you will have about $62,000. After 15 years, you will have about $154,000. After 20 years, you will have about $380,000. After 25 years, you will have close to $1 million. After 30 years, you will have close to $2,400,000. That means your original $10,000 has grown to nearly $2.5 million in 30 years, using only a 20 in every 100 annual growth rate. That is not even the growth rate of the fastest growing companies. The very best companies have grown at 30, 40, or even 50 in every 100 per year for meaningful periods. At those higher growth rates, the numbers become almost impossible to believe. But they are real. They have happened in the past with real companies and real investors, and they will happen again in the future. The catch, of course, is the element of time. Very few people are truly willing to hold an investment for 20 or 30 years without touching it. Life gets in the way, and people genuinely need money for various things. Emotions get in the way, powerfully and consistently. Stocks go up and down, and those movements trigger feelings that lead to action at exactly the wrong moments. The stock market itself throws obstacles in the way. Crashes happen, economies slow dramatically, wars break out, pandemics strike, and all of these events can shake even the most patient and well-prepared investor. But those who manage to stay the course through all of it, who hold on to their great companies and let the compounding work its powerful magic, end up in a completely different and far better place financially than those who do not. The mathematics does not care about your emotions. It does not read the headlines. It simply does what it always does, year after year and decade after decade. It compounds. And if you let it compound long enough in a genuinely great business, the result over a lifetime is extraordinary. Now let us talk about a mistake that many investors make, which Christopher Mayer addresses directly and honestly. The mistake is allowing the desire to avoid paying taxes to drive investment decisions in a way that is harmful to long-term returns. Many investors are understandably reluctant to sell a winning stock because selling will trigger a capital gains tax on the profit. This is understandable, and the tax consideration is real and legitimate. But sometimes, holding a stock purely to avoid triggering a tax is the wrong decision. If the fundamentals of the business have genuinely changed in an important negative way, the right decision is to sell and accept the tax consequence. The tax is a one-time cost that you pay and move on from. Staying invested in a deteriorating business is a continuing and ongoing cost that can be much larger than the tax you were trying to avoid. On the other hand, if the fundamentals are still genuinely great and the business is still growing strongly, then not selling and not paying the tax is simultaneously the right tax decision and the right investing decision. The tax consideration and the investment consideration happen to point in the same direction. So the practical guidance is to always make the decision based on the business fundamentals first. Has something genuinely important changed about the business itself? Then consider the tax consequences after you have answered that primary question. The tax consideration comes after you have decided whether to hold or sell based purely on the merits of the business and its future prospects. This is a nuanced point, but a genuinely important one for long-term investors who have held winning positions for many years. Taxes are real, and they matter, but they should not be the primary driver of your investing decisions. Now let us talk about what Christopher Mayer calls the qualitative factors. These are the things about a company that you cannot easily put a number on or find on a financial statement, but that are nonetheless very important in determining whether a company will grow and thrive for many decades. The first qualitative factor is the culture of the company. Companies with strong, positive, and clearly articulated cultures tend to attract and keep great employees, who in turn build great products, provide excellent service, and make good decisions that compound over time. Companies with toxic, dysfunctional, or unclear cultures tend to drive away good people, make poor collective decisions, waste resources, and eventually decline. You can learn a great deal about a company's culture by reading what current and former employees say about working there, by reading the company's own communications to see what values it truly emphasizes and holds dear, and by observing how the company treats its suppliers, customers, employees, and the communities where it operates. The second qualitative factor is the capacity and desire to innovate. The business world is always changing, sometimes slowly, and sometimes with dramatic speed, and companies that cannot adapt and innovate will inevitably be left behind by those that embrace change. A company with a genuinely strong culture of innovation, one that is always looking for better ways to serve its customers and operate its business more efficiently, is much more likely to remain relevant and growing for the decades that are needed to become a 100-bagger. The third qualitative factor is the integrity and honesty of management. Honest management that treats all shareholders fairly, communicates clearly and transparently, even about bad news, and does not engage in deceptive accounting practices or financial engineering, is absolutely essential for a long-term investment. History is painfully full of companies that looked wonderful on paper and generated tremendous excitement among investors, but whose leaders were secretly deceiving investors about the true state of the business. When the deception was eventually discovered, as it always ultimately is, the stocks collapsed catastrophically, and investors who trusted the numbers lost enormous amounts of money. Protecting yourself from these painful situations requires careful and skeptical reading of financial statements and management communications, and learning to look for warning signs of deceptive reporting. The fourth qualitative factor is the genuine passion of the people leading the company. When you read about a company and its leadership, Do they seem truly passionate and energized about what they are building and where they are going? Passion is not a guarantee of success, and some very passionate people lead businesses that ultimately fail. But it is nonetheless a meaningful positive sign. People who deeply care about what they are doing tend to work harder and more creatively, push through challenges and setbacks that would stop someone who is merely doing a job for a paycheck, and inspire others around them to do the same. Now, let us talk about the role of the broader economy and why Christopher Mayer deliberately downplays it. Many investors spend enormous amounts of time and energy trying to predict what the economy will do next. They try to guess whether interest rates will go up or down, whether there will be a recession, and whether that economic environment will be good or bad for their specific stocks. Christopher Mayer takes a very different and more practical view of this activity. He believes that trying to predict the economy with enough accuracy and consistency to be useful for investing is largely a waste of a serious investor's limited time and energy. Nobody in the world consistently predicts the economy correctly over long periods. Not the most famous economists with their advanced models. Not the most successful investors with their vast experience. Not the most experienced analysts with their enormous research teams. The economy is too complex, too interconnected, and is influenced by too many unpredictable human and political and natural factors for reliable and consistent prediction. Instead of trying to predict the economy, Christopher Mayer focuses single-mindedly on finding the best businesses. The best businesses can grow and thrive through a wide variety of different economic conditions over time. Yes, even genuinely great companies slow down temporarily during recessions. They are not completely immune to the economic cycle, but they recover strongly when the economy improves, and they often come out of recessions actually stronger than they were before, because they had the financial strength to survive and invest while weaker competitors were struggling to stay alive or going bankrupt. By focusing intently on business quality rather than on economic predictions, the 100-bagger investor avoids the frustrating and largely futile exercise of macro forecasting and instead spends valuable time on something that is genuinely useful and actionable, namely, understanding individual businesses deeply and finding the rare ones with all the qualities needed to grow many times in value over many years. Let us also address the important question of diversification. How many stocks should you own at any given time? This question gets a great deal of debate in the investing world, and the honest answer is that there is no single right answer for everyone. Some experienced investors say you should own many stocks, perhaps 50 or even 100, to diversify away the risk that any single stock failing will seriously damage your overall results. Others argue convincingly that you should concentrate your portfolio in just a handful of your very best ideas, because owning too many stocks makes it impossible to know them all well enough and leads inevitably to average returns. Christopher Mayer does not take an extreme position on either side of this debate. He acknowledges honestly that diversification has real value as protection against a single company failing and taking a large piece of your wealth with it. But he also recognizes clearly that true 100 baggers tend to come from concentrated understanding and conviction about a business. If you own 100 different stocks, you simply cannot possibly know all of them deeply. You will inevitably hold some that you do not truly understand, which means you might make poor decisions about them at critical moments. You might sell them at the wrong time when you should hold, or hold them when the fundamentals have changed and you should sell. The practical approach he suggests is to find a reasonable middle ground between the extremes. Own enough stocks that a single catastrophic failure will not ruin your overall financial picture. But do not own so many that you cannot keep track of them and understand them all well enough to make good and confident decisions. For most individual investors who are not doing this as a full-time profession, owning somewhere between 15 and 30 stocks spread across different industries is a reasonable and practical range. This gives enough diversification to protect against any single failure, while still allowing you to know your holdings well enough to manage them wisely. Now let us talk about what Christopher Mayer calls fishing where the fish are. This vivid phrase means you should focus your search for 100 baggers in the places where they are most likely to be found, rather than searching randomly or focusing on what happens to be in the news. We have already established clearly that small companies are more likely to become 100 baggers than large ones. So focusing your search deliberately on smaller and less well-known companies is the equivalent of fishing in the waters where the fish actually live. But there are other important ways to apply this insight too. Industries that are growing rapidly are more likely to produce 100 baggers than industries that are shrinking or simply maintaining their current size. Countries and regions where economic growth is strong and where more people are entering the consuming middle class are more likely to produce 100 baggers than those where growth is slow and structural. Business models that benefit naturally from recurring revenue, powerful network effects, and high switching costs are more likely to produce 100 baggers than those with low barriers to entry and easy competitive copying. By deliberately focusing your search in the right places, you dramatically increase the probability of finding the next great winner before it becomes obvious. You are not relying purely on luck or on stumbling across something by accident. You are intelligently and deliberately stacking the odds in your favor by looking where the best opportunities are most likely to exist. Now let us talk about the emotional journey that comes with actually holding a potential 100 bagger through its full journey. Christopher Mayer is admirably honest about the fact that the road to 100 times your money is not a smooth and comfortable straight line going steadily upward. There will be significant corrections along the way. There will be scary market crashes. There will be periods when the stock falls by 30 or 40 or even 50 in every 100 in price, and yet the company is still fundamentally fine, still growing, and still on its long-term path to becoming a 100 bagger. These large price falls are frightening in a way that is very hard to describe to someone who has not experienced them with real money at stake. When a stock you own falls 30 in every 100, the natural human response is real pain and an almost overwhelming desire to stop that pain by selling and getting back to cash. The financial media will be full of scary headlines predicting further declines. People around you will be panicking and selling everything. Your own portfolio screen will show a big red number telling you exactly how much you have lost in dollar terms. All of this creates an enormous and almost irresistible pressure to sell and end the suffering. But if the company is still fundamentally great and still on its long-term growth path, selling during these scary falls is one of the most expensive mistakes you can possibly make. The patient investor who held Amazon through every one of its many terrifying drops of 30 or more in every 100, and there were many such drops during Amazon's journey, was rewarded with one of the most extraordinary returns in the entire history of publicly traded stocks. The investor who sold every time it fell that much, trying sensibly to avoid further pain, missed most of the most powerful part of that extraordinary journey. This is not easy advice to follow in practice. It requires real and deep conviction in the fundamental quality of the business. It requires the kind of thorough understanding of the company and its competitive position that makes you genuinely confident that the price fall is temporary and that the fundamental growth story is still fully intact. It requires the emotional discipline to consciously separate the price of the stock from the underlying value and prospects of the business behind it. The price can fall for many different reasons, and many of those reasons have absolutely nothing to do with the business itself. The broader market might be falling as a whole due to fear or uncertainty, dragging everything down with it, regardless of underlying quality. Investors in a particular sector might be selling en masse for reasons that have nothing to do with any individual company. There might be a temporarily disappointing quarterly result that scared some short-term investors, even though the long-term story is completely unchanged. In all of these cases, The right response for the long-term investor is to hold firmly, or even to buy more at the lower and more attractive price if you have available capital and the business is as strong as you believe. The investor who can do this calmly and consistently, who can hold on through other people's panic while trusting their own understanding of the business, is the investor who will ultimately capture the enormous and life-changing returns that genuine 100 baggers deliver. Let us now discuss the role of financial statement analysis in finding and monitoring potential 100 baggers. Christopher Mayer believes strongly that every serious investor should develop the ability to read and understand the basic financial statements that all publicly traded companies must publish. These include the income statement, the balance sheet, and the cash flow statement. The income statement shows how much revenue the company earned and how much it spent during a period of time and what profit remained after all expenses. The balance sheet shows what the company owns and what it owes at a specific point in time, and therefore, what the net value of the business is from a purely accounting perspective. The cash flow statement shows how much actual cash moved into and out of the business during a period of time, which is often different from the profit shown on the income statement due to various accounting adjustments. Each of these statements tells a different and important part of the story of the business, and together, they give you a more complete picture of the financial health and direction of the company than any single number or summary statistic could. You do not need to be a professional accountant to read these statements productively. You do not need a graduate degree in finance. But you do need to develop the ability to look at a handful of key numbers and understand clearly what they mean and what they are telling you about the business. Is the revenue growing consistently from year to year? Is the profit margin staying stable or ideally improving as the business scales? Is the company generating more cash than it spends on its operations and capital investments? Is the debt level reasonable and manageable relative to the earnings power of the business? Is the return on invested capital high and consistent across multiple years, suggesting a durable competitive advantage? These fundamental questions can be answered by carefully reading the financial statements, and the answers will tell you a great deal about whether the company has the qualities needed for a potential 100 bagger. Christopher Mayer also strongly emphasizes the importance of reading the management discussion and analysis section of the annual report, which is the part where the management team explains in their own words what happened during the year and what they expect in the future. Great management writes this section clearly, honestly, and in genuinely plain language that any reasonably educated reader can understand. They discuss both the positive developments and the negative ones with equal candor. They take personal responsibility for mistakes rather than attributing everything bad to external factors beyond their control. They explain their strategy in a way that is logical, consistent, and easy to follow. Weak or dishonest management writes this section in a vague and confusing way that seems designed to obscure rather than illuminate. They use a great deal of technical jargon and financial language that sounds impressive but communicates very little. They emphasize only the good news and carefully downplay or simply ignore the bad. They constantly announce new strategies without explaining why the previous strategy was abandoned. Learning to read these management communications critically and with appropriate skepticism is a skill that takes time and practice to develop, but it is extremely valuable once you have built it. Now, let us return to the concept of the owner-operator and explore it more deeply, because it is one of the most important and recurring themes throughout the entire book. Christopher Mayer has studied the great business success stories from many decades of investing history and found a pattern so consistent that it cannot be dismissed. The companies that grew the most over the longest periods and that created the most wealth for their patient shareholders were almost always run by people who were deeply and personally invested in the outcome. This could be the founder of the company, who started the business from nothing with personal capital and personal effort, and who feels a deep an irreplaceable personal connection to what it has become. It could be a long-tenured leader who has spent 2 or 3 decades building the company from a small operation and has accumulated a very large ownership stake through that devotion of time and effort. It could be a business family that has passed both the ownership and the leadership through generations, each one building on what the previous generation created. In all of these cases, the leader has a powerful and deeply personal reason to make the company succeed over the very long term, not just this quarter or this year. They are not thinking about how to impress the stock market analysts who will write reports about the next quarterly earnings number. They are thinking about the next decade and the one after that. They are building something that they want to be genuinely proud of, something they want to pass on to the next generation in even better condition than they received it. This long-term vision and commitment is enormously valuable and produces meaningfully different decisions than the short-term thinking of a hired manager working toward a quarterly bonus target. Short-term thinking leads to decisions that boost the immediately reported numbers, but quietly weaken the business over time in ways that are not immediately visible. Long-term thinking leads to decisions that might reduce the immediately reported numbers, but build lasting strength and competitive advantage that compounds in value over many years. Investment in research and development for future products that may not generate revenue for years. Investment in employee training and development that builds organizational capability slowly. Investment in customer relationships and satisfaction that pays off over many years of repeated purchasing. All of these things cost money and reduce reported profits in the short term, but pay off enormously in the long term for the patient investor. Owner-operators are fundamentally more willing to make these long-term investments because they are thinking about the business they will own for the next 20 years, not the earnings they need to report next quarter. This is why identifying and investing with great owner-operators is one of the most powerful and reliable ways to find potential 100 baggers. When looking at any company, one of the first and most important questions to ask is who is running this company, and do they truly think like an owner who will be here for a very long time? If the honest answer is yes, that is an extremely powerful positive signal that deserves serious weight in your overall assessment. Now let us talk about what happens when you combine all of these positive qualities at the same time. Think about what you have when you find a small company in a large and growing market, with a powerful competitive advantage, protecting it from competition, led by a passionate and deeply committed owner-operator, earning a high return on invested capital, with the ability to reinvest those earnings at that same high rate for many years to come, carrying little debt and plenty of cash, showing a consistent track record of growing revenues and earnings, and trading at a reasonable price that does not yet fully reflect all of this long-term potential. That combination is what the ideal 100-bagger candidate looks like. It is rare. Finding such a company takes real effort, real study, and real patience. You will look at many companies and find that most fall short in one or more of these areas. Most companies do not have all of these qualities at the same time, but some do. And when you find one that does, and when you buy it at a reasonable price, and when you have the discipline and patience to hold it through many years of growth and through the inevitable scary moments along the way, the result can be genuinely life-changing. 1 or 2 genuine 100 baggers in a lifetime of investing can set a family on a financial path that changes the quality of their lives for generations to come. The power of a 100 times return is that profound, and that is not an exaggeration. Let us now spend some time on the psychological and behavioral aspects of this investment philosophy, because Christopher Mayer dedicates significant attention to them, and rightly so. He understands that even if you know everything in this book perfectly in an intellectual sense, you will still face moments of doubt and fear and temptation that threaten to derail your carefully laid plans. One of the biggest ongoing psychological challenges is comparison with what other people are doing and apparently earning. When the broader market is rising sharply and you see people around you making money quickly on hot and exciting stocks, the temptation to switch your strategy and join in chasing those gains is very strong and very human. But history shows clearly, and without exception, that the hot stocks of one period are very rarely the great investments of the following decade. The things that everyone is most excited about are usually already priced very highly to reflect that widespread excitement. There is often very little remaining upside because the enthusiasm has already driven the price to a very high level relative to any realistic assessment of the fundamental value. The best investments are usually in companies that most people are not yet excited about. The companies that are quietly building their business, compounding their returns, and strengthening their competitive advantages year after year without generating much excitement or media coverage. The companies that seem boring and unexciting compared to the thrilling stories of the moment. These are the ones that can still multiply many times in value from their current price because their potential has not yet been reflected in an inflated stock price. Staying focused on these less exciting opportunities while everyone else is chasing the hot thing of the moment requires a genuine and deeply held confidence in your own strategy and its long-term effectiveness. Another major psychological challenge is dealing with the natural volatility of the stock market. The market is volatile by its very nature. Prices go up and down all the time, often for reasons that have absolutely nothing to do with the fundamental value of the businesses behind the stocks. If you check your portfolio every single day, you will see a great deal of movement, and that constant movement will create a constant stream of emotions. If prices are up today, you might feel confident and good and be tempted to buy more simply because prices are rising. If prices are down today, you might feel worried and bad and be tempted to sell simply to stop the uncomfortable feeling of seeing your account value decline. Neither of these emotional responses is a good guide to investment decisions. Christopher Mayer suggests checking your portfolio much less frequently than most investors do. Not every day, and not even every week. Maybe once a month or once a quarter is enough for a long-term investor. This reduction in the frequency of checking dramatically reduces the emotional impact of short-term volatility and makes it much easier to stay calmly focused on the long-term story of each business you own. When you do check your holdings, force yourself to ask the right questions. Not, is the stock price up or down today or this week? But rather, are the businesses I own still growing at a healthy rate and still maintaining their competitive advantages? Is the fundamental case for owning each company still as strong as it was when I bought it? If the answer to those questions is yes, the short-term price movement is largely irrelevant and should not concern you. And one more psychological challenge worth discussing in some depth is the fear of missing out on something exciting that is going up quickly. This happens when you observe an investment opportunity that looks interesting, start to convince yourself it might be a great long-term opportunity, and then watch it start to go up in price before you have completed your research and bought it. The fear of missing out on further gains can push you into buying at a much higher price than is truly justified by the fundamentals. This is a dangerous trap. The discipline to wait for a genuinely reasonable price, even if it means watching a stock rise without you owning it, is an important and valuable part of long-term investing success. Not every great company is a great investment at every price. Sometimes, the very best decision available to you is to do nothing, to wait, and to be patient for a better opportunity to emerge. Even if that means sitting partly in cash for a period of time and watching some stocks rise without you. Being in a hurry to put all available money to work simply for the sake of being fully invested is a path toward owning mediocre businesses at poor prices. The better approach is to always maintain a clear list of great businesses that you would genuinely love to own for the long term, and a specific price at which you would be willing to enthusiastically buy each one. Then, wait with patience for the market to offer you that price. Sometimes, you wait a long time. But when the opportunity finally comes, you are ready and prepared to act quickly and decisively. Now let us talk about some additional insights from the book that are worth exploring in depth. Christopher Mayer talks about the concept of low capital intensity as a very powerful and underappreciated quality in a potential 100 bagger. A capital-intensive business is one that needs to constantly spend large amounts of money on physical equipment, factories, infrastructure, or inventory just to maintain its current level of operations, let alone to grow. These businesses are like a very hungry machine that consumes money as fast as it generates it. They have much less free cash flow, meaning the cash left over after all necessary spending, available to reinvest in growth or to return to shareholders. A low capital intensity business, by contrast, is one that can grow significantly without needing to spend enormous amounts of money on physical assets. Software companies are perhaps the best and most obvious example of this beautiful quality. Once a piece of software is written, it can be sold to millions of customers without a proportional increase in the cost to produce it. The cost of writing the original software is essentially fixed. Each additional copy sold, or each additional subscriber gained, is nearly pure profit with minimal additional cost. This is an extraordinarily capital-efficient business model. The more capital-efficient a business is, the more of its earnings can be directed toward growing the business rather than simply maintaining what already exists. And the more that can be reinvested in growth at high rates of return, the faster the business can expand and the more value it creates for patient shareholders over time. This is a significant reason why technology companies, and particularly software companies, have produced so many of the most spectacular 100 baggers of recent decades. Their business model is inherently capital light, which means their ability to compound earnings rapidly is very high. But technology is certainly not the only place to find capital-light businesses that can compound powerfully. Consumer brands, financial services businesses, certain kinds of business services, and some kinds of healthcare businesses can also be very capital-light and very efficient at generating returns on the capital they do employ. The key measure to examine is how much capital the company needs to maintain and grow its operations relative to the earnings and cash flows it generates. High return on invested capital, sustained over many years, is the clearest and most reliable measure of this quality, because a company with very high return on invested capital is by definition not requiring enormous amounts of capital to generate each dollar of earnings. Now let us talk about one more important concept that Christopher Mayer discusses in detail. He emphasizes the importance of looking specifically at earnings per share growth rather than just total earnings growth, and understanding why the distinction matters. This distinction matters because sometimes a company can grow its total reported earnings while simultaneously issuing a significant number of new shares to employees as compensation or to raise additional capital by selling new stock to investors. When new shares are issued, the existing shareholders own a proportionally smaller piece of the business. So even though the total earnings of the business grew in dollar terms, the earnings per share that belong to each existing shareholder might not have grown by as much, or might not have grown at all. You want a company that is genuinely growing its earnings per share, not just its total earnings on paper, because earnings per share is what directly and proportionally benefits you as an existing shareholder. Even better for existing shareholders is a company that is actively buying back its own shares in the stock market rather than issuing new ones. When a company buys back its own shares, the remaining shareholders each own a larger proportional piece of the business. That means even if total earnings stay exactly the same, earnings per share goes up because there are fewer shares outstanding to divide those earnings among. And if the company is buying back shares when the stock is trading at a genuinely cheap price, this is an especially good and value-creating use of capital that generates significant long-term value for patient shareholders. The very best companies combine genuinely growing total earnings with disciplined and thoughtful management of the total share count over time. They do not wastefully issue shares to overpaid executives in amounts that dilute existing shareholders significantly. They do not carelessly raise money by selling new shares simply because the stock is having a good run. Instead, they grow their earnings, manage their share count responsibly, and opportunistically buy back shares when the stock trades at prices that make sense relative to the business's intrinsic value. The result is earnings per share growth that compounds very powerfully over the years and decades, creating substantial and lasting value for the shareholders who are patient enough to hold through the full journey. Now, let us bring all of these ideas together one final time and think clearly about the complete picture of what the ideal 100-bagger candidate looks like. The ideal candidate is a small company in a large and rapidly growing market. It has a powerful and durable competitive advantage that protects it from competition over long periods. It is led by a passionate owner-operator who thinks in decades rather than quarters and is deeply committed to the long-term health of the enterprise. It earns a high return on invested capital, indicating efficiency and competitive strength. It has ample opportunity to reinvest those earnings at that same high rate for many years to come, fueling powerful compounding. It has little or no debt and maintains a healthy cash position, giving it financial resilience and flexibility. It has a consistent and growing track record of increasing revenues and earnings over many years. It is available at a price that is fair or reasonable relative to its genuine long-term potential. And it has a business model that is capital light and generates strong and growing free cash flow year after year. Does such a company exist at any given moment in time? Yes, absolutely. Several of them exist at any given time in various markets and industries around the world. Finding them is the real challenge. It requires dedicated reading, patient research, the willingness to look in places that most investors overlook, and the courage to buy something that not everyone has heard of and to hold it for many years before the rest of the world recognizes and rewards its true value. But the reward for doing all of this work correctly is extraordinary and life-changing. One or two genuine 100-baggers in a lifetime of thoughtful investing can set a family on a financial trajectory that lasts for generations and changes everything about what is possible in their lives. The power of a 100 times return is exactly that profound. Let us now do a complete and thorough review of all the most important lessons from this remarkable book. The first lesson is that 100 baggers are absolutely real, and they are findable by any patient and dedicated investor. The second lesson is that the key characteristics to look for are high return on invested capital, the ability to reinvest at those high rates for many years, a strong and durable competitive advantage, a growing market with plenty of room to expand, and skilled and committed owner-operator leadership. The third lesson is that small companies offer the most potential precisely because they have the most room left to grow, which is why looking beyond the household names is so important. The fourth lesson is that the price you pay when you first buy a stock matters enormously, and you should never overpay, even for a genuinely great business, because the price you pay determines a significant part of your ultimate return. The fifth lesson is that holding on through the fear and the excitement and the noise is the hardest and yet the most important part of capturing the full return of a 100-bagger, and most investors fail at this step even when they have gotten everything else right. The sixth lesson is that the coffee can approach, buying great companies and holding them for many years without overreacting to short-term price movements or scary headlines, is a powerful and historically proven strategy that most investors find very difficult to maintain consistently. The seventh lesson is that avoiding big and permanent losses is just as important as finding big winners, because compounding requires an unbroken chain of growth, and a catastrophic loss breaks that chain in a way that is very hard to recover from. The eighth lesson is that emotional discipline, the ability to hold on calmly when prices are falling, and to resist chasing when prices are rising rapidly is the quality that separates average investors from truly extraordinary ones over long periods. The ninth lesson is that financial literacy, the ability to read and critically understand financial statements and management communications, is an enormously powerful tool for finding and monitoring great long-term investments, and it is a skill that anyone can develop with effort and practice. The 10th lesson is that patient and long-term investors have a profound and lasting advantage over short-term traders because compounding rewards time above almost all other factors, and the longer you give a great business to compound, the more extraordinary the results become. These 10 lessons, taken together, form a complete and coherent philosophy of long-term investing that any individual investor in any country and at any level of experience can understand, embrace, and apply to their own investing. Not everyone who reads this book will have the patience and discipline to apply all of these lessons fully across an entire investing lifetime. Not everyone will ultimately find and hold a genuine 100 bagger, but everyone who takes these lessons seriously and applies them with genuine discipline over many years will be a substantially better investor than they would have been without this knowledge. And some of those people will find their 100 bagger, and when they do, they will understand clearly and deeply exactly why they found it. They will know that it was not primarily luck. It was the result of clear and disciplined thinking, patient and systematic searching, careful and ongoing research, and above all, the courage and emotional strength to hold on through all the doubt and fear and noise while the rest of the world was selling or chasing something different. That is the complete and authentic gift this book offers to every reader who approaches it seriously. Not a shortcut to easy riches, not a clever formula that removes the difficulty of investing, but a clear, well-reasoned, and thoroughly researched framework for finding the greatest opportunities available in the stock market and having the wisdom, the knowledge, and the emotional discipline to hold them long enough to collect the truly extraordinary rewards they eventually and inevitably deliver to those who stay the course. That is what 100 baggers truly are, and that is what this magnificent and important book by Christopher Mayer teaches with such clarity, depth, and honesty. Every investor, whether young or old, whether a complete beginner or many years experienced, whether managing a large portfolio or just starting with a small amount of savings, would benefit enormously from reading and rereading the lessons in this book and applying them with patience and genuine conviction for as long as they choose to invest. The opportunity to find the next 100 bagger is real, and it exists right now. The time to start building the knowledge and the mindset to find it is right now. The method, the framework, the principles, and the wisdom are all in this book. All that is ultimately needed is the will to study it carefully, the patience to apply it consistently, and the courage to hold on long enough to collect the reward.